A Tesla and SpaceX merger is not an announced deal, but it is no longer a strange question. Tesla disclosed that it acquired about $2 billion of SpaceX Class A shares in March 2026. And after SpaceX moved into public markets, investors began asking whether Elon Musk could someday combine the companies. This episode is a scenario analysis, not a prediction that a deal will happen. The question is simple but enormous. Would one company be stronger than two? Or would Tesla shareholders be asked to pay too much for a very different business? To answer that, we need to separate the exciting story from the hard financial questions. First, why does a merger sound logical at all? Tesla is changing from a car maker into a company that sells batteries, energy systems, autonomy, robots, and AI computing. SpaceX is changing from a launch company into a communications and infrastructure company through Starlink. Both need advanced chips, large amounts of power, software talent, manufacturing skill, and long-term capital. Both also depend heavily on one leader's willingness to fund projects that may take years to pay off. Supporters see a shared industrial system. They imagine Tesla batteries powering data centers, Starlink connecting vehicles and robots, and SpaceX launch capacity supporting an orbit-based communications network. They also see one larger balance sheet funding projects that may be too expensive for a single company. The strongest argument is capital allocation. SpaceX has a launch and satellite business with large growth ambitions. Tesla has public market access, a global manufacturing base, and a loyal retail investor base. If the combined company could move capital to the highest return project, it might reduce duplicated spending. There is also an AI argument. Tesla trains models for driving and robotics. SpaceX operates a vast communications network and builds hardware for harsh environments. In theory, shared compute, networking, and engineering teams could create useful tools faster. But a strategic connection is not the same thing as a good merger. The first problem is that the businesses have very different risk profiles. Tesla investors own a volatile public company tied to vehicle demand, margins, energy storage, and hopes for autonomy. SpaceX investors own a company tied to launches, government contracts, Starlink growth, regulation, and huge technical bets. Combining them may diversify risk. It may also make each business harder to understand. That matters because a merger price must be fair to both sets of owners. Tesla is publicly traded every day. Its price is visible, even if investors disagree about its value. SpaceX would have a newer and less settled public valuation after an IPO. That makes the exchange ratio unusually sensitive. If SpaceX is valued too high, Tesla owners could give away a large part of their company for future promises. If it is valued too low, SpaceX owners could reject the deal or claim that Tesla captured their upside. The key phrase here is control premium. A control premium is extra value paid above a company's market price to persuade shareholders to sell control. In ordinary large public company deals, premiums often fall in a broad range around 20 to 40%. But this would not be an ordinary deal. It would involve a founder who has influence on both sides, businesses with very different liquidity, and valuations built partly on future technologies. That should push investors toward a disciplined range, not a headline-grabbing number. Our base case would start with a modest premium of roughly 15 to 25% over SpaceX's unaffected trading price. That range would recognize control without assuming every possible Starlink, AI, and Mars dream is already proven. A premium above 30% would need unusually clear evidence of near-term synergies. For example, signed contracts, measurable shared infrastructure savings, or a binding plan that changes cash flow within a few years. Without that evidence, a very high premium would mostly transfer risk from SpaceX holders to Tesla holders. There is a second valuation issue. Tesla itself often trades with a premium because investors price in autonomy, Optimus, energy storage, and AI. If Tesla uses richly valued shares to buy SpaceX, the deal can look attractive on paper. But that does not make dilution disappear. Dilution means existing shareholders own a smaller percentage after new shares are issued. The real test is whether each Tesla share owns more long-term earning power after the deal than before it. That calculation needs honest assumptions about revenue, margins, capital spending, debt, taxes, and execution risk. Now add Elon Musk's compensation structure. Tesla's 2025 CEO Performance Award was approved by shareholders and granted about 423.7 million performance-based restricted shares. The award is linked to market value and operational goals, and its design gives Musk a major financial reason to pursue extremely large outcomes. That alignment has two sides. Supporters say he earns more only if shareholders also win big. Critics say a package tied to giant valuation milestones can encourage moves that make a story larger, even when a simpler structure would be safer for Tesla owners. A merger could intensify that tension. If combining Tesla and SpaceX creates a much bigger market capitalization, it may support the kind of scale embedded in those milestones. That does not prove the transaction would be wrong. It does mean the board must examine whether Musk's personal incentives are different from the best interests of Tesla's minority shareholders. This is called a related party transaction. It is a deal where a person with influence has interests on more than one side. The best protection is not a friendly explanation. It is process. Tesla would need a truly independent special committee, its own legal and financial advisors, and a fairness opinion that addresses both value and risk. Musk should not negotiate the exchange ratio for both companies. Unaffiliated Tesla shareholders should have a meaningful vote. The committee should publish clear sensitivity tables showing how the deal changes under different SpaceX values and different premium levels. Investors should also see a standalone plan. In other words, what can Tesla achieve without buying SpaceX? If Tesla can fund autonomy, energy, and robotics alone, the burden of proof for a merger becomes much higher. The case for a deal is strongest only if the combined company can do something that separate companies cannot do nearly as well. One possible synergy is connectivity. Starlink could give Tesla vehicles, fleets, and robots resilient data links in locations where ordinary networks are weak. That could be valuable, but it is also something the companies can achieve through a commercial agreement. Another possible synergy is energy. Tesla's batteries and power electronics may help SpaceX ground systems and data centers. Again, a supply contract may capture much of that benefit without a merger. The same is true for AI chips and robotics research. Partnerships can share technology while preserving separate boards, capital budgets, and shareholder choices. This is why opponents say a merger may solve a governance problem for Musk more than an operating problem for the companies. They worry Tesla becomes a public financing vehicle for projects whose payoffs are distant and difficult to measure. They also worry that Tesla's existing business receives less management attention. Tesla still has to sell cars competitively, improve service, protect margins, scale storage, and prove autonomy safely. Those are not small tasks. SpaceX has its own demands: launch reliability, satellite replacement, spectrum policy, government relationships, and the cost of global expansion. Putting everything inside one company could create a giant innovation platform. It could also create a giant organization with too many priorities. There are regulatory questions too. Space is not just another consumer technology market. SpaceX works closely with governments and handles sensitive launch and communications infrastructure. A merger with a globally traded car and AI company could attract scrutiny on national security, foreign ownership, export controls, and competition. Tesla's China exposure would make those questions even more complicated. No valuation model can simply assume regulators will approve every structure quickly. So what should investors watch next? First, formal filings, not social media speculation. Second, whether Tesla discloses more investments or commercial agreements with SpaceX. Third, the exact independence of any committee created to study a deal. Fourth, the premium, the share exchange ratio, and how both boards justify them. Finally, watch the alternative. If a partnership can deliver Starlink connectivity, energy projects, or AI collaboration without an acquisition, that may be the cleaner answer. The merger case is not absurd. There are real technological links between Tesla and SpaceX. But the financial case is much harder than the story suggests. The best deal would need a moderate premium, strict independent governance, transparent dilution analysis, and synergies that cannot be achieved through contracts alone. Until those conditions are visible, investors should treat a Tesla and SpaceX merger as an interesting possibility, not an automatic value creator. That's all for today's episode. When one founder sits near both sides of a giant deal, the process matters as much as the vision. Thanks for listening, and we'll see you next time.